everybody for joining today. Today we're welcoming Josh Gurton from Metro Bank and Darren Hodson from PKF Smith Cooper. Josh has had some technical issues. We'll have had to evacuate his building, so he's on his phone. So apologies if he comes in and out, but thankfully Darren's going to hopefully be picking things up for us. We'll be picking things up, I'm sure, very well. But bear with us if there is some technical issues. But hopefully it will all go smoothly. So I'll hand over to Darren and Josh if he's able in a moment. But what we'll do at the end of the presentation, if you have any questions, please put them in the chat box. And at the end of the presentation, I'll come back to you so you can ask the question directly to Darren and Josh. So we'll save that to the end. But well, without further ado, why don't I hand over to Darren and Josh if he's there? I can't tell. To carry on, and then we'll catch up afterwards.
Well, thank you, Ben. As Ben's already alluded to, this has already started differently to how we planned. And Josh was going to share the document, but I now have that honour. So let me just call up the doc, and I'll share this, and then we'll get going. Just put it into full screen mode. So this session is on raising finance for a management buyout. Clearly, there's probably lots that can be said on this topic, and given the timeline, we'll keep it, ultra high level, but allowing you lots of time to ask questions. The agenda really is we're going to talk a little bit to start with about us, just explain who we are. And then move through into raising finance. And the first bit we'll start on is how we structure a management buyout. We'll go through an example of using some numbers about how the buyout could be funded. Josh, hopefully, is around. If he's around and his phone's working, talk through the debt position and how Metro assess putting debt into a buyout. We've got a little bit on process as well, and then we move into the Q&A bit. So the first part really is about the speakers. So Josh, hopefully you can hear us, and I don't know whether you want to introduce yourself.
Yes, yeah, thanks, Darren. So apologies, everyone. It seems as I went out for a sandwich, five fire engines turned up at the office, and I wasn't allowed to get back in to get my laptop or anything. So apologies for that. So yeah, as Darren said, so I'm a corporate banking director at Metro Bank. I joined now coming on about 9 months ago. So previously an M&A advisor, actually working with Darren himself at PKF. And now I sit within the large corporate and structured finance team at Metro. And what that means is we work with a wide variety of businesses, and actually a deal leader alongside being a relationship manager. So at Metro Bank, particularly if you source and generate a deal, actually you become the relationship manager going onwards. So someone who understands the deal, understands the dynamics, and can look after the business going forward.
Okay, thanks, Josh. And I'm Darren Hodson. I'm a corporate finance partner at PKF. I'm ex-Big Four, so I used to work at Deloitte, and before that at BDO. Broadly, 25 years experience of doing deals. This is advising clients on how to buy and sell, but deals ranging from 1 to 250 million. I've been involved in many management buyouts, EOTs, and family restructurings, so lots of fundraising expertise. My firm is a global firm, but in the UK, we're one of the largest deal doers. We transact last year we transacted on 3.4 billion of deals. That was over 200 transactions. Broadly, that's an average of a 17 million deal. And our sweet spot really is probably in the 1 to 50 million space. And we've got a plethora of skills, but probably similar to Josh, we're kind of advising private clients. That's fundamentally our ethos as a firm. Josh, do you want to cover Metro?
Yes, yeah. So I guess it's most people will know of Metro Bank more from, I guess, the high street stores and I guess the fairly new challenger bank aspects of it. Since 2023, however, there's been a big shift in focus at Metro Bank towards corporate and commercial, and hence uh, me coming into Metro Bank and a number of other relationship directors, essentially looking to support mid-market companies. And whilst we did that before 2023, actually we're putting a big focus on it, and we cover a range of transactions, a range of businesses, public, private equity backed businesses as well. Across a number of transactions, we typically fund debt of 1 million to 50 million. And we're quite flexible on structures and different facilities. So we've got a wide range of products, and that can be term debt, revolving credit facilities, and then your asset-based lending solutions as well.
Yeah, and from an advisory perspective, we see Metro as one of the more active funders in buyouts at the moment. So they're kind of good on a transaction. So now if we're kind of moving to raising finance for a buyout, there aren't that many slides. I just don't know if you see that as a positive or a negative, but this one's fairly key. And I guess a lot of people don't actually understand when we meet them that, how can management buy a business if they've got no money? So, we're often asked that question about how the structure of it, and where do they get the money from? Clearly, they can't afford to do this, because if they had millions, that have already have the business. And that's really where we step in. But if we kind of look at that first blob on the top left, most entities have you've got a hold co. There might be subsidiaries below, and that's owned by, say, existing shareholders. It could be 1, it could be 10, doesn't really matter, but normally there's a structure like that. And what management do to start raising funds for buyout is set up a new co. So there's a new company that management own, and let's just say that's 100%. And Nuco then raises the funds, and I'll come back to stage 2, to buy the target. So if you kind of look at stage 3 now, you kind of got management team, you've got a possible investor that sits to the right, you've got Nuco, and you've got Nuco owning 100%. So the funds raised are raised by the legal entity, not by the management team personally. And it's those funds that go into Nuco that allow you to acquire the target. And I guess that stage 2 box where, Nuco raises funds, where do management get the money from? And what's the money used for? Well, first of all, there's a purchase price for a business. So that could be, 20 million. Management team will say, well, we need working capital to continue trading, so we might need some additional cash. And then there's deal fees. So raising money costs fees, basically. Costs arrangement fees with the funders. It costs tax structuring. There's professional costs. There's diligence. There's legal costs. There's quite a raft of things that go into deal fees. So there's a whole club of items that you need to fund when running a buyout, which is what we've put on the left, which is the funding requirement. And then on the right of that fulcrum, we've got a number of different pieces. So if we start with external debt, that is what we're saying Metro provides. So Metro Bank would say lends so much money to the business, and that's probably a fairly fixed amount. You can kind of flex it a bit up and down, but there's a cap to how much debt you can raise. You can use cash reserves within the business itself. So some vendors prefer to roll up cash in the company rather than extracting it. And the reason they do that is because they generally can get that money out at capital gains tax rates rather than dividend rate, which gives them a saving. And basically, you can use the reserves in the business itself to lend up into Nuco to then acquire the target. So that's the structure. And then there's management equity. And as a general principle, and this does depend on the type of deal that you're doing, management are generally asked to put in one-time salary as their equity. So if someone's on, let's just say 100 grand, and there's only one person in the management team, they would need to put in broadly 100 grand, and that is basically seen as hurt money, an incentive for the management team to look after everybody else's money, is the general concept. So if you total up those elements, you might not come to the full value of the business. So then you're into, well, what else can you do? Well, the vendor could roll consideration, so deferred consideration, or you could go to the private equity markets, maybe mezzanine debt, to raise some more. And that's the fundamentals of a management buyout. It's trying to pull together all of those sources and uses to get to a deal structure. I've put at the bottom of this slide alternative structures such as EOTs, employee ownership trusts. We're seeing that take more prominence these days instead of management buyouts. EOTs allow vendors to sell their businesses with zero tax. And the management team, basically you sell to all the employees, but the management team could own up to 49% of the business outside of the rest of the employees. And so they're seeing it as a hybrid way of creating a management buyout. There's lots of nuances with EOTs, and I'm not going to go into it today because this is not an EOT discussion, but I just reference it as it's something that does exist, and it is an option. And some of the fundamentals of what we're talking about here for a management buyout apply to an EOT. So that's the very high level funding. If we then go into, well, what could that look like? I've tried to create this kind of simple example where, say, a business is with a 2.5 million EBITDA, so profitability 2.5 million, could be valued on a 6 times multiplier. So let's say 15 million. It's got no debt, it's got no cash, and there's 5 members of the management team. Well, on the bottom left, using that same fulcrum, we've got a price of 15. The fees might be 1.5 million. I've ignored working capital for now. So the total fundraise might be 16.5 million. And on the right, I start to get into, well, how is this going to be funded? Well, there's a piece from management. So I've just said, well, management will put in 100 grand each as hurt money. And then we'd raise debt. And debt, the amount of debt that's available does depend on each business. But Metro, as an example, would raise up to, I think it's 3.5 times, Josh, isn't it?
Yeah, and in special cases we can go a bit further than that. But as Darren says, it comes into the round of the quality of the business, quality of the management team, and the deal structure.
So if you kind of look at those two pieces, I've just put in 3 times the 2.5. So we've got 8 million raised, we've got a gap of 8.5 million, and that comes back to how's it going to be funded? Well, fundamentally, there's probably only 2 options, which is the vendor rolls and waits for the money, or we get private equity in. To get private equity in, they would require a return of, this is very broadly, and I know you had a growth finance update, and I wasn't sure last week, and wasn't sure exactly what was covered on that. But if that was all equity funded, they would want 2 to 3 times that money back. So that puts the pressure on management to grow the business. And as a general rule of thumb, you need to double the size of the business to get that level of return to make it work. Otherwise, you're probably into needing to do some kind of deferred, and it could be that the business is being overvalued and you should value it less. So there's lots of component parts that go into it. Josh, do you want to cover debt considerations?
Yes, yeah. So thanks, Darren. So I guess debt in most management buyouts provides a large chunk of the considerations. So there's not that many management buyouts that take place which don't incur debt. So I guess what do we look at when we're provided a structure of an MBO from an advisor like Darren? So we want to work with the management team to make the deal work for everyone. So what does that mean? And on Darren's balancing trick with the two sides, actually, most people want to maximise day one considerations. So they to agree a deal, the seller wants to take away as much as possible. But in terms of a debt piece, actually, when we're looking at maximising that day one, we want to make sure that we're not restricting the business going forward in terms of cash. So we don't want to restrict the management team in the future with decisions they make by putting too much debt into the business where actually you don't have the cash to go and grow the business how you'd like. So what do we look at when we're assessing that? We'll look at forecasts, we'll look at models that the management team have presented. How does our debt fit into that piece? So we'd overlay our debt into that model and look at covenants going forward as well. So how can we satisfy that debt is going to be repaid over the term? Now, there's various structures that you can do in terms of debt. So you can have bullet and interest only structures, you can have amortizing structures, and you can have a mix of both. But also, a lot of businesses have a lot of unencumbered assets. So actually, how can we structure it to be the most affordable way to put debt into a business? Can we secure that debt against some assets? So, for example, a business may have a lot of trucks or machinery which doesn't have any debt against it. Actually, can we refinance that machinery or trucks to mean that the borrowing costs come down slightly? So, alongside that, I guess looking at what we would then produce to take to our credit team internally to say this is an MBO that we should support. So our credit papers will look at the management team, so CVs, experience. It will look at the financial history of the business. So whilst we take a lot of comfort in forecasts and models, actually, what has the business achieved historically? Are those projections realistic? The assumptions behind them founded by what's gone on in the past and what the management team want to do, and that goes into the future growth plans. So we want to make sure that actually the debt that we're providing is facilitating what the transaction wants to do. So if the management team is buying it to go and grow it, we want to make sure we're structuring that debt to mean that you can go and do that. So that could mean follow-on funding as well. So there's situations, and I'll allude to it to the right with Slicker Recycling, where we will back a management team and put that into a business and actually look for when they grow in the future to continue that funding to keep providing that growth capital. So I guess looking to the right, I'll start with Slicker. So Slicker is a long-term relationship of Metro Bank. And that started back in 2018 with some invoice finance and asset finance to essentially facilitate a transaction that occurred. Since then, Slicker has grown significantly with our support, and we've continued to provide follow-on funding for that business in the form of term loans, other asset finance lines, etc. So we really back the management team in there, and it's a really strong business where they've taken over the business and gone on to grow that. Similarly with Oxygen Active Place, so this was a recent deal that I completed a couple of months ago. So we've worked with Oxygen for a number of years now as well. They're backed by Literacy Capital, who are a private equity house or listed investment fund. So we work alongside Literacy, providing the debt to back the management team to go and grow that business in terms of acquisitions and refurbishments of existing sites. And actually, as that business has grown, we've continued extending our funding lines to be able to support that and back the management team. I won't go through any other examples for the sake of time, but if anyone has any questions following this call, then please reach out to me.
Yeah. And I just had one very quick slide on, kind of looking at a buyout and how to fund it, we'd have hours of meetings with the clients just to go through this. But as a broad process, clearly there's a valuation point. You've got to get to a value for the business. You've got to get to an offer and structure an offer. To go and raise finance, you'll need a business plan. You need a model to go with it, and then you can start the fundraise to secure the deal. So that's just a very, very high level process, also conscious of time. So I will move on to questions. Appreciate that's very whistle-stop tour, but does anybody have any questions?
Thanks, Darren and Josh. That's great. If anybody has any questions, rather than all shouting out, it might be easier just to stick something in the chat box, and I'll try and work through them in order. I can't see any in there just yet, but feel free to type away. Either type it now, we can ask it directly from your text, or we can come and ask you to display it. So,
yeah. Or if anybody wants us to go back to particular parts on the slide.
Yeah, or if anybody wants sort of clarification on any parts of it. So, there we go. They're coming through now. So, Adam, thank you. So, is there a structure that allows the management team to be lent money and take a larger equity slice? I don't know.
Well, the most optimal structure for management is to just use to kind of use a debt and vendor finance deal. So if the vendor wants to exit, can we start in a different place for that question? Adam, do you mean to buy out a small stake to start with and then increase it, or do you mean to do a buyout?
Hi, can you hear me?
I can.
Yeah, sorry, me here. So just stepping back a little bit, 2024 was actually a difficult year for the business. And I came in about June 24 when the business was on its knees. We've stabilized it. We've put one entity into administration. And so 2024 numbers look terrible. The existing shareholders are tired and want to get out. So I think there is a chance to get a significant stake in it, potentially buy all of it, and maximize that return. So there's an element of how do you optimize that, and could you, for example, buy 100%, but you would effectively be doing a PG against debt to borrow the money to buy it, for example. I presume that's a separate discussion with a lender outside of structuring this to buy the business itself.
Yeah, I think the short answer to that is yes. That is doable. Something to put into your head, which Josh may or may not like, is you can insure against PGs as well. So there's separate insurance on PG.
Yes, I've seen some of those. Yeah,
and it's probably that type of deal. Depending on the business, you might be able to get funding support, and as Josh referenced, you might be able to get more asset backing around the business to get, to max it out, because the cash flows probably won't do that. So it depends on the amount of asset finance. But you could also kind of leave I'll call it a royalty, or something in there for existing shareholders to get future value as well, so that they're incentivized to go and do this deal. So those are the things that instantly come to mind on that question.
effectively you're putting them off risk, but then giving them an upside option going forward. So make them whole, give them an upside. But you're paying lower now, so you're on risk for less. But going forward, your reward will be limited or restricted because they get some of it.
Yeah.
Okay. Thank you.
Thanks, Adam. It's pretty easy if I go back to the people asking the questions to ask them rather than me trying to interpret or misinterpret. But Vivek, you had a question about debt terms.
Yeah, I just wanted to ask, what are the typical debt terms? Obviously, it depends upon other factors, but generally, what's the broad range you should expect?
Josh, sounds like one for you.
Yeah, so it's difficult to say, I guess, typical debt terms, because it's assessed in a round for the business. So that can depend on sector, the management team, etc., and it can depend on the structure as well. However, I think a good rule of thumb is that most businesses should be able to raise around 2 to 3 times EBITDA of debt. So that's typically what you see. Some at the lower end, some are at the higher end. But typically, you'll be able to raise about that much debt within a business, given it's got strong trading history, etc. Now, if it's a new business or fairly startup, then that becomes a bit harder to raise that much debt. But I'd say 2 to 3 times EBITDA is probably a good rule of thumb, and I'd assume that's probably what Darren sees most of the time as well. In terms of the terms of the facility, so typically at Metro, we normally put about 2 to 3 covenants within a facility agreement, and that would be for an unsecured facility. So essentially, just taking a debenture over the business, and those covenants will typically cover sort of EBITDA, leverage, and cash flow available for debt service typically.
And I mean, I would say it tends to be 5-year money.
Yes, yeah.
But it does, depends on whether you're maximising asset finance, which tends to be shorter term, unless it's property. But cash flow lend tends to be 5 years. Someone like Metro can do higher bullets than, say, the standard high street banks. So I always start with the base principle of 60-40, of 60 amortizing, 40 bullets on a cash flow lend. But as Josh said, it does depend on each business fundamentally of whether that works. And some banks can be more aggressive than others. And I think Metro is one of the more flexible banks, which is why we work with them closely, because we've got strong terms. Josh, is there anything you can say on rates?
Yeah, so again, rates are dependent on the transaction, but in terms of, I guess, we typically charge a margin over base. Now that margin will be in the mid single digits normally. And just to second what Darren said, so looking at bullet and amortizing tranches of debt, actually, what if I'm looking at a deal that's come to me and someone's asking to structure a bullet into that deal, I'd like to see what is that bullet supporting with. So why is that extra cash needed to not pay down debt? What are you doing with that cash? Is that to finance growth? Is that to support any incentives that you've got going on? So that's the sort of thing I'd look at assessing in terms of those structures. But as Darren said, we can be fairly flexible on interest only and amortizing tranches at Metro.
Okay, got it. Thank you.
Right, so thank you. And got a question about level of deal fees from Pete Hills. Sorry, I haven't got your...
Yep,
No.
sorry, it's Phil. Yes,
Right.
as we saw on one of the earlier slides, the funding has to cover the purchase price and deal fees. And I know deal fees are not generally cheap, but is there some sort of just rough range if I was putting together some sort of initial estimate of how much would need to be funded that I could use as a percentage of a purchase price, for example, or a range?
Yeah, so I always start around 10%. And 10%, that is assuming there's external finance. The deal is 100% external finance. So a large chunk of that goes on arrangement fees for funders. So it's not, Josh can comment on Metro, but it's not untypical for arrangement fees to be 3-4%. So you start with that before getting into how do you access the funds, raising the money and the legals. So as a broad steer, I go 10%, and then, but very quickly I do try and work out what do we need and when. And if it was all vendor financed, that would dramatically reduce. And if it was bank finance, it's probably a bit further down as well. So it does depend on the blend, but 10% is a good guide.
Thanks very much.
Thanks, Phil. Nigel, you had a question. I'm just still there. So, no, I can ask it. The question from Nigel was: if lending comes from your current bank, how do you seek a private equity partner?
If lending comes from your existing bank?
Yes. Yeah, for your current bank, how do you seek a private equity partner?
So the process is much the same. So if I go back to this process slide, well, kind of the start point is what's the gap? So if you've got debt in the business, is that already maxed out? So I'd ask that question. So have you got 1 times money in or 2 times? Do you need more in? Because debt is cheaper than equity, just as conceptually. So management want more debt in as long as it doesn't damage a business. So you'd want to maximize your existing lender. But then you're into, well, actually, you need a business plan, you need a model, and then you'd go and have a beauty parade. And somebody like me can say, I think you should speak to these 5 parties because they're best suited to you. But you can, this is what I call the Rothschild approach. So you can just go to all of market and go to 100 private equity funds and get them to bid. But private equity like to meet management. So the only real value is if it's just how many meetings are you prepared to have with these equity houses. But you just overlay the same structure in essence. You can reduce the price for the existing debt in the business and then just go and raise the equity. Hopefully that makes sense.
Hopefully that covers that. I'm not sure if
Great. Yeah. Thanks. Sorry, I think my microphone wasn't working. So yeah, thanks for that. Cheers.
Okay. Thanks, Nigel. Thanks. Excellent. Any more questions from anybody or anything anyone wants to recover? Well, I can't see anything in the chat box. I think we've got everything covered. Please do shout if we haven't. Anything else? No? Lovely. Okay. Well, in which case, thank you very much for coming along. We will have a recording of this afterwards if you need to refer back to it in our members area, Eugenie. So do feel free to join that, and you can get information from there. And yeah, I mean, well, thanks very much for everybody attending, and thanks to Darren and Josh for taking the time, and Josh for hiding in the park and giving us his input.
Yeah, thank you everyone, and apologies for any audio issues or any connectivity issues.
It's worked very well, Josh. Thank you very much indeed. But thanks everybody. That's all. We'll see you again next time.